Well, I'm absolutely delighted to be back here before you once again, and delighted to be here first time with Sunil. And even though many of you have heard this before, Sunil hasn't heard it before. I'd like to thank him very much for that introduction, for me being at the Fed from 2006 to 2009. And so all of you know, and now Sunil can know, that it's all my fault. I was there when all this happened. But at least today, there's some good news from the Fed. And of course, since we're doing real-time forecasting, my remarks are very different today because of the announcement this morning. And so perhaps maybe since the swaps program that I'll talk a little bit more about, which was announced this morning, similar to a program that we had done while I was at the Fed, maybe I could actually get a little bit of credit for doing something good. No? See, this is what you get in policymaking in Washington. If things go wrong, they know who to blame. If things go right, oh, it was my brilliance of investing in the market at this time. It was nothing to do with you. And so that's one of the challenges in policymaking, and I'll touch on that a little bit in some of the policies that the Fed has pursued since I spoke with you a year ago. Now, obviously, there's been a lot of policy proposals, a lot of criticism of the Fed, a lot of different ideas that have come out from the presidential debates. Had one person ask me about Keynes' 999 proposal, and I said if I hear 999 one more time, I'm going to call 911 because there are a lot of challenges and issues associated with that. Obviously, there have been a number of discussions by presidential candidates of whether Ben Bernanke is a loyal American or not, and I'll try to touch on that also. So what I want to do is just quickly review some of the changes from last year, because of course one always has to give an explanation for why one's forecast was not perfect, and so I'll talk just slightly, just for a couple minutes about that. Talk a little bit about things going forward, and then I want to focus on the issues of monetary policy, particularly the issues that came up today. So, unfortunately, we had some very, very tragic shocks that occurred, but also some good shocks. Unfortunately, both have been problematic for world economic growth, but at least one will be positive for some peoples of the world, and I'm thinking of the Arab Spring. So that was something that was very difficult to predict. Maybe Marvin Zonis could have done that in his political science predictions, but it was something that was very difficult for economists to predict would take place. I think ultimately this can be very, very positive for promoting freedom for a significant fraction of the world, but obviously it creates a lot of uncertainty in the short-term to immediate run about a very important piece of the economy, energy. And so energy prices rose much more than had been expected, have come back down a bit again, but that was certainly something that was unexpected when we made this forecast last year. Second was the terrible tragedy that affected Japan, the earthquake, tsunami, and then the nuclear disaster that followed. This was not only a terrible tragedy for the people of Japan, but it also has a big impact on the world. And what's amazing is that people have focused so much on China that although China has now become roughly the second largest economy in the world, people have forgotten about Japan. Now, it is true that China is obviously growing much more rapidly than Japan is, but it's still roughly this world's second largest economy and is very much integrated into the world production system. So a tragedy that is going to effectively shut down production in Japan for months cannot but help to have an important impact on the rest of the world, and it had a very important impact on the U.S., particularly the auto-related sector. And it's only in the most recent quarter that we started to see some bounce back as Japan has come in. So I think those are some of the shocks that certainly I did not expect that led us to have a lower growth rate in the U.S. and in many parts of the world than I had forecast a year ago. And because of continuing uncertainties in the U.S. on the fiscal policy side, continuing uncertainties in Europe on whether the euro will exist or not, whether they will get their fiscal house in order, the crystal ball is cloudy. Very difficult to make forecasts, but nonetheless, you have the forecast card in front of you, and you can see that my forecast is relatively optimistic, but it's relative to what? It's relative to most people thinking about a double dip. And so the theme of my forecast is no double dip, but a sideways slide. You have to have some sort of alliteration. It seems if you have double dip, then you have to have sideways slide. So that's the thing to, the two letters to take out the SS, you can think of it as the Kroszner SS model of what's going to happen to the economy. So why not a double dip, and why do I have that relatively optimistic approach of at least a sideways slide? Well, I'm reasonably optimistic because I think we had these terrible shocks that hit the economy, but some of those are no longer hitting the economy. We saw stronger growth in the third quarter. We just had a downward revision of GDP from 2.5% to 2%, but that was primarily because there was actually less building up of inventories than had originally been reported. We're now at incredibly thin inventory levels. At those thin levels, it's highly likely that we'll start to see some rebuilding of those inventories. We'll start to see some production coming back up. And so I think we're in for 2 to 3% growth in the fourth quarter, perhaps even slightly above that, depending on what happens with the consumer. So the consumer has been hit with everything possible: uncertainty on the policy front, uncertainty on the international front, the very I'm not quite sure how to characterize it, delicate dance we saw in Washington over the budget this summer. And nonetheless, even though reported consumer confidence went down, consumers have continued to power on. Even in the third quarter, consumption was relatively strong. Income is not strong, but relative to income, consumption has been relatively strong. The savings rate has not been skyrocketing. It's actually even a bit less than I had forecast for last year. So the consumer is not just hunkering down and saying, "Oh my gosh, I don't know what's going to happen. I have to save every penny that I get in." They've been willing to spend, because I think there's at least a little bit of optimism that things will at least slide sideways rather than go into a double dip. Also, there's a lot of uncertainty, obviously, about what's going to happen with the employment situation. And we just got a number this morning that has some correlation, not a very high correlation, with the employment report that will come out on Friday, suggesting that we may actually be having more private sector job growth than many people were thinking. Now, I don't think we're going to have an enormous amount of job growth, because I think the lingering uncertainties on the fiscal side and from Europe are going to make it very difficult to see firms be willing to make the investments necessary for hiring. And I think of hiring as being something that is very much involved in long-term investment. We've been seeing firms being willing to invest reasonably strongly in equipment and software, but not those longer-term investments in structures, not the longer-term investments in hiring. I think we may see a little bit more of that, but still, I don't think we're going to see a dramatic recovery. But one of the things that was a drag this past year, and a drag going forward, is on the fiscal side. Not only the uncertainty, but lower spending growth than has been the case in past years and in past recoveries. This is particularly true at the state and local level. I mean, we here in Illinois know how wonderful the budget is in Illinois, and how we are the leaders in bringing the ratings of the states down. Unfortunately, we have one of the lowest, if not the lowest, rating of any of the states in the union, but unfortunately, we're facing some competition from others in this race to the bottom. So this is naturally leading to a number of states pulling back in their spending, pulling back in their hiring, and so that is going to be a drag. And you can see my prediction there is for a fairly strong drag coming in from that side. Net exports, the other piece of GDP, because we have C plus I plus G plus net exports. I think the U.S. is going to grow a bit more strongly than much of the rest of the world, or certainly the developed world. I think we may see a little slowing in China, some slowing in other emerging market countries, and so I think that means we're going to see a little bit more importing, a little bit less exporting, and so that'll be a little bit more of a drag going forward. Nonetheless, my forecast overall is for 2.7% growth, which is a bit above the consensus forecast, but not too far above the rest. And so there's a slight bit of optimism there. One of my good friends, Tom Ricketts, is here, and I'm always an optimist about the Cubs. Unfortunately, my heart is broken in many, many years, but maybe next year. will be the year. And so maybe this coming year, instead of my predictions being too strong for economic growth, they'll be too weak for economic growth. Well, obviously, it's also been a tumultuous year for monetary policy. When I spoke to you last year here, we had just had the implementation of quantitative easing 2, QE2, which involved a lot more securities purchases by the Federal Reserve. That then concluded in the summertime, and we started to see the economy slow once again. And so the Fed undertook a number of bold policy actions. First, making a commitment to keep interest rates low, not just for an extended period, but giving a date on that through mid-2013. That brought the short end of the yield curve down basically close to zero. Then in the next meeting, they decided to go back to a classic 1960s song, the twist, and did what I characterize as twist and shout. They did a twist, that is, they tried to change the shape of the yield curve. So they already nailed the short rate down at zero. They said, well, what we're going to do in our securities portfolio is sell off the short end and buy the long end. So try to bring the long rates down. And they've been successful at doing that. The long rate in the US is around 2%, lower than it was when this was first being discussed. And they've been talking a lot about how they may be doing more. That's the shout part. So it's a little bit of twist and shout. And a lot of discussions about, well, what's next? Well, this morning we got one of the down payments on what's next. So the Fed is doing something called swap arrangements with other central banks around the world. So what are these things? They allow other central banks to be able to put deposits on account at the Fed. The Fed then gives them dollars, and then those central banks can give dollars out in their economies. Well, why is this so important? Well, the dollar is the reserve currency. Despite all of the negativity, the nattering nabobs of negativism who've been talking about the U.S. and the challenges to the dollar, it's still the world's reserve currency. And so people transact in it, they need it, and it's very, very important that they have access to this. And so what the Fed is doing is it's reducing the cost of that kind of borrowing from 100 basis points, 1%, to 50 basis points. This should give strong encouragement to other banks for banks around the world to borrow. And I think that would be something that would be very important, because the financial markets, this hadn't gotten as much attention as it did in the fall of 2008, are getting close to the same levels of tension that they were in the fall of 2008. If you look at risk spreads and the costs of borrowing, the bank-to-bank borrowing, they're at those levels, and for many of the European banks, beyond those levels. So the Fed wants to try to stay ahead of the curve, sees that this is a very fragile situation, has undertaken this action. But what's interesting about this action is it doesn't pose any risk to the Fed. When they do a swap with the ECB, their counterparty is the ECB. So central banks pay, and so that's so there's no credit risk. There's no foreign exchange rate risk, because the ECB is guaranteed that they will repay the same number of dollars. What the ECB does with it, if they give it out to European banks, they may take on credit risk, but that's their problem, not the Fed's problem. So I think this is something that was very important to undertake. But more broadly, the kind of activities that the Fed has been undertaking have gotten a lot of criticism. As we know, Ben was accused of being potentially treasonous, and also one of the debaters said that this is the most inflationary chairman ever. Well, I think that's not an accurate characterization, but I can understand why, in a certain way, someone may say that. If you look at the Fed's balance sheet, in the last 3 months I was there, the Fed's balance sheet tripled from $800 billion to $2.4 trillion, and is now approaching $3 trillion. So that's a gigantic increase in the size of the so-called monetary base. But that hasn't led to inflation. If you actually look at the inflation outcome since Ben has been chairman, it's actually lower than on average under Greenspan and under most other periods. Well, why has this been? Because the Fed is responding with a lot more supply, because demand has shifted out dramatically. Incredible demand for safe, short-term U.S. assets. And so the Fed has supplied that. In the 1930s, the Fed didn't do that. Milton Friedman basically said that the Depression became the Great Depression because the Fed stood by and did nothing, rather than act the way a central bank is supposed to, provide liquidity in these extreme circumstances. And I think one of the key things that Ben will be remembered for is making sure we did not slip into deflation. Now, he's not getting any credit for this right now, but we also have to think back about 20 years ago or so when Volcker was chairman. He is someone who's now revered. In the early 1980s, when he was raising rates and trying to slay the inflation dragon, he was reviled. We always would see in the Fed, a number of people still had some very kind notes that were sent to the Fed from the construction industry during that time period. And these notes were written on pieces of 2x4s. So there was just a little bit of threat there about what we were doing. Did we not understand what was happening to the markets? And so Volcker was a very unpopular figure, actually I think much more unpopular than Bernanke was. He had just as much difficulty getting reconfirmed. But I think in the long run, we will see that much like with Volcker, who is now revered for slaying the inflation dragon, I think in the long run, people will say Ben Bernanke was a hero for slaying the deflation dragon. And so I'd like to close with a brief quotation. It's a variation on something that Reinhold Niebuhr had said. May God grant Ben Bernanke the serenity to accept the things that he cannot change, the courage to change the things that he can, and the wisdom to know the difference. Thank you very much.